We're speaking top investment trends and themes with Briton Hill. He is the president and partner at Weber Global Management. Welcome to the show.
Thanks for having me, David. Good to be here.
Briton, you mentioned that when Obama became president, you invested in the theme of Obamacare. Now that Biden is president, what macro themes tied to his presidency should investors be looking out for?
Sure. I think one of the biggest things is watch the inflationary numbers. Inflation is here, and I think the biggest indicator and the biggest thing that will kind of impact the economies is how long will it be here? Because if rates stay at 5.5% and yields are only at 2.5% on the long bond, eventually those bondholders are going to say, okay, this isn't a temporary thing. We need to start selling these bonds. And that can cause a dramatic uptick in yields. And I think that gold and interest rates can rise together because this isn't your typical deflationary period. This is an inflationary one. So those bondholders will be selling bonds and then buying gold with the proceeds. So that's one area I like, inflationary hedges, so precious metals, mining companies, especially considering a lot of mining companies are trading at a discount to book value, which means their value on the exchanges is trading for less than the value that they have on paper, whether that's cash assets, et cetera. So if the company was liquidated today, it's worth more than what you're buying it for. SSRM, for example, SSR Mining is one of those. Equinox is one that's trading at a huge discount to book value. So that's one area. But I still really do actually like the medical device sector. I do have investments there. And also this year, especially water. Michael Burry was also a fan of water for quite some time. I like water plays because we're having major droughts right now. And so especially in areas like the Midwest or here in Utah, all of our reservoirs are empty. So companies that actually help water usage and decrease water usage. One pre-IPO play we just did was Indigo AG. They use AI to dramatically reduce the amount of water that crops need and while increasing crop yields. So companies like that. American Waterworks is another one. Companies that specialize in desalinization. There's a great one on the Paris Exchange, Viola. They're one of the largest water companies in the world. So that's an area I like. And I already touched on this medical devices. Affordable Care Act is still here. A lot of people insured. We have an aging population right now. So companies like Stryker, my business partner, Chris, he's got 2 Stryker kneecaps. I'm probably going to have something done to a shoulder from a lacrosse injury that I got in high school. So those types of businesses I don't think are going anywhere. And I actually look at that as defensive.
Now, before we get into your thesis on gold, let's just get your overview of the stock markets. Where do you see markets headed right now and how do you feel?
Sure, David. It's a good question. Right now, it's kind of a tricky landscape for an investor because in my opinion, the stock averages, S&P, NASDAQ, things like that, they could be overvalued. That doesn't mean they don't have room to run. Things can be overvalued for a long time and still rally, but it's definitely cause for some concern. So I like actually the precious metals world right now. I like mining companies. I like gold and silver because I think they represent true value, especially as we have inflationary pressures starting to pick up around the world. Here in the U.S., inflation numbers came out last week. Looks like we're seeing about 5.5%. That's higher than we've seen in a while. So I like to have a good head with precious metals.
Do you think that, for you at least, do you think that gold and precious metals are the best inflation hedge out there?
There's some argument that they may not be a good inflation hedge, especially with the price action we see this year. As a wealth manager, especially ultra high net worth, I get this question a lot because the wealthy are trying to protect their assets and protect their wealth. This year, gold's down anywhere from 5 to 10%, depending on the week. This week, we've seen it kind of climb back up from the lows of last week, but it still remains to be seen how well will gold keep up with inflation. But when you consider last year, gold almost had a 30% year. This year, for it to fall back a little bit isn't out of the ordinary. We're still outpacing inflation if you look at it in those terms.
Okay, interesting. Yeah, it's a good point you brought up. Inflation has been trickling up this year, yet gold has fallen. So. Do you have any speculation or theories as to why that may have happened?
It's another good question. I think what we're seeing is just a natural pullback in what I think is a long-term bull market for the precious metals. You see this happen where things get ahead of themselves and then they fall behind, and so they have some room to rally back. When you have a 30% year in any asset, you're outperforming the averages. So for it to pull back a little bit the following year or for a few months, that's not uncommon. That's not out of the ordinary. But I know it does It is a cause for concern for a lot of investors, especially those that are heavy in the precious metals, and especially as people compare, well, if inflation is 5.5%, why isn't gold moving with inflation? It should be up at least 5.5%. That can cause investors to really start to panic, especially when we see things pull back and go sideways for such a long period of time while other asset classes are rising. But for me, I think that the precious metals still are a good spot to be.
Okay, we're going to come back to gold in your forecast in just a bit. I want to go back to stocks for a minute now, Briton. The equity side, you said, is, the equities are overvalued. But why is it that prices continue to go up, you think?
It's another good question, David. We have a lot of cash on the sidelines right now, and we also have the Federal Reserve injecting a lot of money into the economies, infrastructure plans, stimulus packages. A lot of that money will just go back into buying assets and things like that. So that will push up asset prices. But then, you have some rebound from the COVID, the COVID pullback and the COVID correction we saw last year. So money's getting put back to work. The economy's starting to pick back up. There's a lot of buying still. And as long as cash remains on the sidelines and a lot of that cash is controlled by wealthy people, they're going to keep purchasing assets, and that's going to drive prices higher.
I was reading a couple of media articles have been popping up about Michael Burry taking the opposite side of the trade as Cathie Wood, shorting some of the stocks that she likes, like Tesla. So which camp are you in? Are you in the camp that, tech is going to go to the moon still? Or maybe it's time to take a little bit of money off the table?
I think what we have here, David, is just two different investors who are both very successful at what they do with different mentalities. I would put Michael Burry more as a value investor. He looks for strong fundamentals. When you look at Tesla, you see their price to earnings is 1,000. I mean, it's crazy. So for a value investor, that's just not the move. But for somebody like Cathie, I mean, she's a tremendous investor, a very good money manager. She looks for momentum, and she looks for those sectors that are changing the world and have kind of almost a viralness about them. So it's kind of the battle of two giants. It'll be interesting to see which one overcomes. But for me and how I invest, I tend to err more on the side of Michael Burry. I look for value and things like that.
You've got an interesting philosophy because you also look at pre-IPO stocks. Tell us about that space.
This is a new sector that we've kind of been looking in and investing in. We've done well for ourselves and myself personally, as well as our clients. The pre-IPO space is kind of an area where you can actually find true value for companies that are about to be listed. You can look at the financials, you can compare them to their competitors and determine, based on these numbers, I think I'm getting a good deal and I think the IPO will be successful. The other thing you have when you get in it on these late stage pre-IPO companies, I want to specify late stage. I'm looking at companies that are multi-billion dollar companies trying to be as little speculation as possible. The moment these hit the markets, all of a sudden you have billions of dollars of cash that is going to start buying it. You have these investors on this with money on the sidelines. They see a new company listed, as well as these index funds. The moment these companies get listed on exchanges, now billions of dollars worth of index fund buying needs to happen to add these companies to those index funds. And so it's almost a no-brainer where if you can get a good deal before they go public, the appreciation is there. And we saw this last year with the average IPO rising about 36% in 2020 on their first trading day. So it's an interesting environment. I don't think it'll last like this forever, but for now, we're doing very well with it. Our clients are very happy, and I think it will continue to be an area where you can actually find true value, at least for the foreseeable future.
Okay, let's talk macro now as a bridge to the gold discussion we'll have. You mentioned that a lot of the rally we've seen in the stock markets has been due to Federal Reserve's money printing and the expansion of their balance sheet. Now, do you expect this to continue indefinitely? Do you think that eventually they will need to taper, and if so, when?
I think that they have to continue the stimulus if we want to see asset prices across the board rising. They've kind of painted themselves into a corner a little bit in one sense, but in the other sense, if you were the Federal Reserve, what would you do? You have to lower your interest rates to keep the economies going. You have to add stimulus to keep things going. Interest rates at this point in time, we've seen they can go lower. One only needs to look at Europe to see that our long-term and short-term rates can go lower than where they're at now. It doesn't mean it's good for the economies. I think that eventually there will be a day of reckoning, and interest rates certainly have a lot higher to go than they do lower with inflation at 5.5% and 30-year yields sitting around 2%.
Right.
you're losing in real terms, and that can't keep up forever. Eventually, your bondholders are going to get frustrated and they're going to start dumping their bonds. Now, the Federal Reserve can control short-term yields all they want, but when it comes to long-term yields, I think the market is in control of that, and that's your long-term bondholders. If they want to dump those bonds, they will.
So interest rates rising eventually, you said. What will happen to the equity side if that eventually does happen?
I think that we're going to see, I think that we're going to see a lot of asset prices struggle to keep up their performance if we have an environment of rising interest rates. It's certainly going to affect the housing markets. People are leveraging themselves to the hilt right now at these really low rates. Good for them, lock it in. But on the flip side, if those rates start going up, even though you've locked in a low rate, you run the risk of your asset prices falling back because people are going to have to account for the increased interest expense when they're purchasing those assets.